Hi, I'm Becky Sheets with Fairway Independent Mortgage, and today I want to talk to you about mortgage insurance. It is one of the most common questions that's asked when a first-time homebuyer comes to me with questions, and they're getting a lot of conflicting information. And some of that information is correct and some of it's not, and some of it just depends on the individual situation. At Fairway Independent Mortgage, we treat you as an individual, and so it's not a cookie cutter situation. So we're going to ask you a lot of questions before answering your questions to find out what is the best fit for you. Mortgage insurance is required when you have less than 20% down on your loan, and it protects the lender in the event that you default on the loan or there is a foreclosure. What mortgage insurance does for you as the borrower is it allows you to have less than 20% down. You know, when you're buying your first home, a lot of people don't have 20% down, but you still want to take advantage of a low rate. You still want to take advantage of equity. And so it just ensures the lender so that they're willing to let you borrow with less of a down payment. When you're getting mortgage insurance, the answer to this question is going to really vary depending on the client. At Fairway Independent Mortgage and the Sheets Lending team, we treat you as an individual, and everybody is different. Everybody has a different credit score. You have a different down payment. You may have different goals for your house. You may want to be in the house for only 2 years before upgrading, or you may want to turn it into investment property, or you may think this is the house you're going to retire in. So it really depends on what your long-term goals are, and that's going to directly affect the advice that we give you as far as how we're going to structure your mortgage insurance. On certain loan types, such as USDA and FHA, mortgage insurance may be for the life of your loan. And if you decide to refinance later and not pay mortgage insurance, that would be one way out of it. But for conventional loans, you actually pay mortgage insurance for a certain time period and then it drops off. So depending on the answers that you give me to your, to the questions I ask you, I will give you different advice depending on what your goals are. For USDA and FHA loans, your mortgage insurance rate is not negotiable. It is the same rate for everybody regardless of credit score. However, on a conventional loan, a lot of people don't realize that your mortgage insurance rate is negotiable. You may have heard the term PMI. PMI stands for private mortgage insurance. And when you're getting a conventional loan, we at Fairway Mortgage, we shop from several different PMI companies. A lot of banks and credit unions do not. They have one, maybe two that they look at, but we have several. And what this allows us to do is not only give you the best interest rate, but give you the best mortgage insurance rate, which directly affects your payment. We'll shop from several companies and we'll see what is the best fit for you to save you the most money possible. Yes, there is a way to avoid monthly mortgage insurance. If you're getting a conventional loan, there are so many options nowadays that weren't available several years ago, and one of them being upfront mortgage insurance. So you may see advertised loans out there that say 3% down, no mortgage insurance. Well, that is possible, and it actually doesn't mean there is no mortgage insurance. It just means they're letting you pay it up front. So you can pay upfront mortgage insurance, you can pay monthly mortgage insurance, and now there's an option to do something in between, which we call split MI. And it just basically allows you to buy down your mortgage insurance rate where you pay a fee and it lowers your monthly mortgage insurance. In most cases, this actually saves you the most money over the long term. The only time that that's not true is if you think you're actually going to stay in the house for 2 years or less, but most of the time you will break even at about the 2-year mark. So my advice is come on in, let's talk about your situation specifically, and let's not only shop interest rates, but let's look at different mortgage insurance rates and see what best fits you and your family. You've probably heard a lot about mortgage insurance from different friends and family, but it is a complicated subject sometimes. So I invite you to come on into my office, give us a call. I'd love to talk to you about it, answer any of your questions, because knowing is better than wondering. And if you're thinking of buying a house in the next 6 to 12 months, it is not too soon to come in and have your credit pulled, because your mortgage insurance rate is directly affected by your credit score. So I would love to take a look at it now and see if there's anything I can do to bring your score up and give you the best mortgage insurance rate possible. So give us a call at 253-797-1316 and visit our website at sheetshomeloans.com. I look forward to helping you into your next home.